Hi everyone, it's Stacy and Tony here for Remax Elite Team in Temecula and Marietta Lifestyles, and we're sitting again with Tobie Love out of South Pacific Financials, and we are going to talk about something today that some people need and some people don't, and there's a reason why and there's a reason not. But I want to talk a little bit about mortgage insurance. I've heard it called MI and PI and mortgage insurance, and I don't know what all that is. Can you help me understand just a little bit?
Yes, absolutely. Well, again, thank you and Tony so much for having me here today. Love doing these videos with you guys, and just an opportunity to educate the world on some of the things that can be sometimes very, very confusing in the lending industry and the real estate industry. So mortgage insurance. So it can be called a PMI, private mortgage insurance, mortgage insurance, upfront mortgage insurance, monthly mortgage insurance. So what does all that mean? Right. So ultimately, the first thing I want to tell you is that mortgage insurance does not protect the client. Basically, mortgage insurance protects the lender in the event the client defaults. So that doesn't mean that the client gets off the hook and doesn't owe the mortgage company. It just means that it mitigates some risk that the lender takes when loaning money. So, and therefore, for that reason, a lot of times the mortgage insurance is based off of a credit score and a loan to value. So the higher credit score you have, the lower mortgage insurance premium that you might have. So it revolves around a bunch of different things.
And so I've heard too that mortgage insurance is it dependent upon how much you put down?
It does.
Okay.
So let's talk about conventional for a second, because mortgage insurance pretty much applies in all cases except for VA. And there's a funding fee that is involved with VA, but that's a little bit different. So we'll talk about that in a couple seconds. But mortgage insurance is required on all conventional loans unless you put down 20% or more. On FHA loans, no matter how much money you put down, whether you put down 3.5% or 20%, you're going to have mortgage insurance. And then USDA, also mortgage insurance is required. And again, no matter what you put down. Yep. And then VA doesn't have a monthly mortgage insurance, but they do have a funding fee that the veteran or active duty would pay up front unless for some reason they're exempt.
Okay. And is that for the life of the loan?
So on conventional, no, just until, let's say on conventional that you put down 3%, then you would have mortgage insurance until you reached 75% loan to value.
Gotcha.
And 2 years. So you can avoid it up front if you put down 20%. But if you go into a mortgage and you have mortgage insurance, then you have to get to 2 years and 75% before you can petition it off.
Okay.
FHA, whole life of the loan, unless you put down more than 10%. If you put down more than 10%, then after 10 years it can be petitioned off.
Wow.
Yeah, so that's still a really long time.
There's just a lot to know.
There is.
Absolutely a lot to know. So we wanted to say thank you very much to Tobie for joining us today, and I hope you're enjoying our series of videos with Tobie on financial readiness and home loans and mortgage insurance and all sorts of things. So again, thank you so much for sitting with us. If you like these videos, like them, share them, and we'll talk to you soon.